When you sit down at your terminal, you might picture thousands of other individuals across the world reading the tape and making decisions alongside you. But the reality is quite different, dominated by endless, quiet stretches of humming hardware operating continuously in the background. Over 90% of daily market volume is generated by automated program trading algorithms, leaving less than 10% to manual retail action. This 90% operates autonomously, fracturing into high-speed data nodes executing at scales no human can match. Yet the typical manual trader attempts to navigate this environment using static chart patterns and historical support lines mapped out on a lagging screen. The math of that interaction is straightforward. A human waiting for visual confirmation to physically click a mouse cannot compete with institutional flow that evaluates and fires thousands of times in the same second. Operating without accounting for that 90% threshold ensures you are trading blind to the primary structural force dictating price direction. If you trade manually, you know the cycle. You locate a textbook technical setup, wait for confirmation, enter your position, and immediately get stopped out on a sudden sharp reversal. It leaves you questioning the screen. You are forced to figure out if your analytical skills are degrading, or if the underlying mechanics of price movement have structurally shifted out of your favor. We are going to look strictly at how algorithmic entities route modern market flow and walk through the exact steps required to align your trading edge for 2026. For a performance-driven trader, realizing that legacy retail frameworks are failing is a necessary analytical step. It is the baseline requirement for upgrading your approach. To understand the friction of a purely manual approach, look at the required inputs, staring at classical price action and mapping out widely recognized historical support and resistance zones. Because those inputs derive from past data, your reaction to algorithm-induced momentum shifts is severely delayed. This line chart demonstrates a classic breakout pattern, highlighting exactly where manual traders are triggered to buy, right before the price collapses into a trap zone. Refusing to upgrade your inputs guarantees a high-friction environment where this trap repeats constantly, generating unpredictable losses. Automated liquidity-seeking flow is programmed to find heavy clusters of standing orders. The obvious stop losses placed by retail traders right below classical support lines are actively targeted to fill large institutional orders. Trying to trade against that system manually, without the ability to track institutional volume footprints, leaves you with a severe mathematical disadvantage. There is a direct alternative: learning to accurately read the specific volume signatures that program trading leaves behind in the data. This matrix outlines the differences between a traditional manual market approach and active algorithmic awareness, broken down by speed, tracking, and education. Recognizing programmatic signatures allows you to drop lagging indicators, aligning your entries alongside institutional momentum rather than getting run over. To make that transition, there is a strict cognitive trade-off. You must discard nearly everything retail resources have taught you about how the market moves. Relearning market mechanics from a strictly institutional perspective requires navigating a very steep learning curve. Crossing that gap requires focused, structured education. Specifically, intensive curriculums like our Program Trading 101 and 501 seminars. Once you know how to map algorithmic flow, institutional momentum stops acting as a sudden threat and becomes a quantifiable, predictable edge. Doing this correctly requires an objective commitment. It means sacrificing a full weekend of your time to sit down and study. The 101 and 501 seminars require rigorous mental effort to absorb and apply high-level institutional concepts. This quadrant chart plots effort against impact. Self-taught trial and error requires years of isolated struggle, landing in the high-effort, low-impact zone. By contrast, a focused weekend seminar requires immense concentration up front, but yields the highest possible impact. The cognitive demand of this curriculum is a necessary cost. It is the only reliable way to bypass an expensive cycle of trial and error. Knowing that algorithms command 90% of the market, you have to look at your own operations and determine if you actually need this level of training. If you are a casual hobbyist trading for entertainment, looking for quick stock tips or easy line drive exercises, this approach will frustrate you. This flowchart illustrates the decision. If you are satisfied with that level of engagement, maintain your current strategy. Institutional education is a poor fit for casual goals. However, if you want to treat your trading as a highly analytical, data-driven business, your path is different. For analytical traders, identifying that 90% volume block is no longer an optional upgrade. It is a mandatory operational baseline for 2026. If that matches your profile, the upcoming April 11th and 12th weekend seminars are your definitive next step. Your long-term ROI is ultimately determined by matching the correct educational tools to your specific level of ambition. To evaluate the curriculum, open programtrading.com/seminars/spring-2026.htm, bookmark that page and study the material closely. When you are ready to prepare for 2026, reply to us via email to reserve your go-to meeting slot for Saturday and Sunday, April 11th and 12th. As you read through the link, questions will arise. You can email us for a prompt reply or call us directly at USA 561-747-5000, and we will consult with you on your specific situation. In a market built by algorithms, structured preparation is your only sustainable advantage. We look forward to helping you upgrade your edge.